Hello and welcome to another episode of Monday Markets. As always, we're brought to you by Woo. Link is available in the description below. So BTC has obviously had a bit of a dip. Altcoins kind of got slaughtered across the board. I was just looking through my watch list before this video, and these have given back really a large part of their gains depending on where you look, especially the weaker ones. They've just essentially fully retraced a lot of the price action that they've enjoyed in the past weeks and months, and sort of the day before yesterday really marked an acceleration in that. And there's a ton of altcoin dispersion just in general. So structurally, some of these still look salvageable. Others are, again, essentially full retraced, if not broke down from really long and large ranges and consolidations. So a bit of a mixed bag there. I generally don't have a ton of alt appetite at the moment. That is for two reasons. Reason number one is that the day before yesterday was one of the better entry days, where you got a lot of wicks on those altcoins and playing those short-term mechanical bounces when you get liquidations and significant mispricings from that. I think that trade has played out and we're left with a lot of ugly looking altcoins as a result. That's always a very short-term trade when you get really a large cluster of liquidations and entries that you wouldn't ordinarily get. Those don't tend to be generational in nature. They're more sort of mechanical. You get a price that you wouldn't hope for in ordinary conditions, and then when it bounces 20, 30, 40%, you just get rid of that shit and then reassess the landscape. And it's not uncommon on those types of bounces for the market to sort of retrace some portion back towards the deep wick that was made and sort of slow down and become a bit shitty to trade. And so given we're now 2 days after that large flush, I think a lot of alts just look like they want to backfill those wicks, or even the strong ones in many cases have ended up closer to resistance than they are to support. So contextually, yes, there's a very good altcoin trade, and in general trade you can make when shit melts down, which is to go wick fishing. But that wick fishing trade is A, done, and B, the result of it being done. Most of these now are much closer to resistance than support. The second reason why I'm not super high on altcoins at the moment is because if you look at the altcoin dominance by open interest, if you take an average of these highs, and certainly pre-breakdown, it was sort of 19, 20 billion in altcoin open interest is the rough number. And that essentially got halved to 11 billion, slightly less than half, obviously, but this is a huge nuke in altcoin open interest. Now, when it comes to open interest nukes, my personal view is that on average / in general, open interest wipeouts are a good precursor to trend continuation. When you get the most leveraged, most aggressive participants washed out of the instrument, they tend to provide for good entries via their liquidations, and then off you go, the strong trend can continue. I think that's true, again, on average, but the exception to that, at least in my mind, is when you get these really big, large-scale wipeouts in open interest, not sort of local, micro, one-day flushes, but just like a halving like we had here, for example. That kind of stuff usually takes longer to resolve and skews more towards trend reversal than trend continuation. Now, again, a ton of caveats apply to this. For example, altcoin dispersion has been massive compared to previous cycles. It's also been the case that Bitcoin's just been bailing out a lot of the market as a whole, and the broader market, that's been the tide that's been lifting all the boats. And so if Bitcoin goes up, then obviously that becomes invalid, so on and so forth. And also, we run a weekly show at the end of the day, so my views can change in 1 or 2 days, or even after recording this video. But just in general, with the available evidence at the moment, I'm not a huge fan of rushing into altcoins when you get a mega open interest wipeout, unless I'm trading the short-term liquidations. But the short-term liquidations are done. We're now in the sort of post open interest wipeout bounce era, and that doesn't tend to be particularly favorable, at least for me on the long side, and it's not a trade that I love. So hopefully that makes some sense. Again, could be wrong as always, but these mega open interest wipeouts I'm not a huge fan of. I think there's a real risk that they make the case for broader trend reversal as opposed to trend continuation when it comes to alts. So yeah, let's take a look at BTC. I think the most relevant timeframes are the weekly and the daily. The reason for that is, specifically the reason the monthly has been omitted from that list, is that realistically, you're only going to be getting monthly signals sub 58.8K, 59K, at which point we can make the argument for a failed breakout on this monthly time frame and make the argument for monthly support being tested. But at the moment, this is not there, and it's trading at 64K, and there's no monthly signal to be derived from that. The weekly, on the other hand, I think you could make a case, or at least it's sort of technically more interesting. If we look at this low close that we had at 67.2, For me at least, and there are a million ways to splice up market structure and people have their own views on this. And again, this is where TA becomes more of an art than a science, but calling TA science would be absurd in the first place. But nonetheless, I look at higher high closes and lower low closes on high time frame for market structure. And for me, this sort of last weekly close was a weekly break in market structure. Again, that's a very loaded term and a lot of definitional obsession as to what that means. So you could call it whatever you like, but it's weekly weakness via a lower low close in one form or another. It's been a while since we've had this on the weekly time frame. Unsurprising given how BTC has been trading. Even during the ETF week, when we had that big move from 49k all the way down to 38k, weekly market structure on a closing basis, or I guess just the candle closes if you want to avoid using the term market structure, they sort of remained intact and there was no lower low close, whereas at the moment we do have a lower low close, and it's been a while since we've seen that essentially. So I think that's worth treating somewhat seriously and giving it some respect and some space. And if you wanted to be really conservative on a swing basis, then you could just cluster out this entire mini consolidation and argue that if I want to be long on the weekly time frame, I either need to do it at high time frame support on a deeper dip or back above 67 to 69k. I think it's a very reasonable view. It's my view at the very least when it comes to the weekly, and that's sort of why this time frame has my attention, because of this subtle shift in the form of a lower low close and a new level, if you will, that has emerged as a result between 67.2 and 69k. The daily time frame is the second most interesting time frame. We are back once again at this range, this sort of extremity at 61.1 to 62.5. This is arguably the third test of this level, depending on how you count. And we've spoken about it on Casual Friday, fudding it at the bottom, as always, and on Monday markets as well, where essentially you have one test, two tests, and now a third test as well. I know people also count this differently. So for some commentators, this is one test, 2, 3, and then 4, 5. In any case, the way I tend to view these things is that if a level is fresh and untested, I will just trade it for what it is and trade it outright. And the more it gets tested and the more the market keeps coming back to it, I become more reluctant to trade it just as a level blindly on its own, and instead wait for some sort of washout or potential failed breakdown opportunity at the level itself. Now, sometimes that means that the market will just come into these levels that I think are getting a bit scary and battered. It'll tap them perfectly and then go up, and I'll think, oh fuck, well, what was I waiting for? What kind of washout? This was a bad decision. But that is just trading. You know, you can't. I don't think it's particularly wise to go through every single possible permutation of the market. Like, what if it bounces here? What if it breaks down and bounces here? What if it reclaims this? What if it breaks down and keeps going? I don't think it's a particularly useful decision tree to have. At a certain point, you have to make a choice and pick the stuff that's interesting and essentially narrow down the potential trade opportunities that make sense for you and that you know how to trade. And so for me, now that we've had essentially 1, 2, sort of a triple tap at this level, I'm no longer interested in buying that support just as a support in its own right. A potentially interesting trade would be a breakdown attempt that takes out a bunch of these lows and then to assess whether there's any absorption going on and whether there's a failed breakdown trade. So for example, if it were to come down and sort of poke through all these lows, but have a really positive response and end up closing back above 62.5 on the daily time frame, it doesn't have to be the next day, it doesn't have to be a V reversal, right? It could just, like, for example, just get absorbed with a bunch of shorting and then blow them up and close above. Anything of that type of nature would be valid, but a resulting close above 62.5 post washout, I think would be a very interesting daily time frame setups. If it happens, great. If it happens and still goes down and eats shit, that's the cost of doing business. If it happens and just keeps going down, you know, all these sort of possible ways in which it could go wrong, that is just trading. But for me, just on its own terms, the potential setup of failed breakdown into reclaim, so take out these lows and then back above 62.5 in one way or another, I think would be an interesting long trade. Anything other than that, I'll probably miss/not be interested in. And if the breakdown ends up not failing and being a real breakdown, sort of breakdown and then acceleration, for example, or breakdown, consolidation, acceleration, at that point, I will just be looking for lower levels of support to do business. And hopefully we have time to do a show before that, if that were to happen. So this is kind of similar to previous Monday markets, where essentially the argument is, hey, we have a range low here. We've spent a lot of time here. I don't want to trade the level itself anymore. I want to trade a breakdown attempt of some sort. That's still my view here. Also, in general, as we start to discuss ETH and a bunch of these alts, when you get these larger market moving liquidation type of days, the best day to get entries is obviously on those days, and then the usually green day that follows if there's any type of mean reversion. The problem with making a video right now on Monday is that we've had the crash day and we've had the bounce day, and in many cases that bounce day has taken even the stronger stuff into local areas of resistance. So it's a bit of a mechanical trade where you sort of get the dislocations caused by liquidations on crash day, and then you make the bulk of your profit either that day or the next day. But then on the 2-3 days after, depending on how the sort of pattern plays out, sometimes longer, once you get the sort of mechanical dump, which is a lot of liquidations, and then the sort of mechanical mean reversion, once both mechanical legs are done, the market can kind of slow down and become a bit shitty to trade. Be that for flow reasons, where post-liquidation flow, once you've had the bounce, tends to be a bit heavy and shitty, or from a contextual risk-reward point of view, once you've had both sides of the sort of mechanical dump and mechanical pump, or mechanical pump and mechanical dump, depending on the market direction, it sort of ends up at resistance or ends up at support, and you're kind of like, I feel like I've missed out the more attractive trading portion of this move. And I think that applies to BTC and several of the altcoins as well. Nonetheless, I still think there's a clear level to work with, and if it gives something, interesting. If it doesn't, sort of too bad. I guess we'll still be stuck within this range, and we'll have to refer to lower timeframes for some guidance. If we look on the 4-hour and hourly, the reason I've sort of omitted them is because they essentially show what the daily time frame shows, just with more candlesticks. So I think that logic can be transplanted to those time frames if you want either tighter risk definition or something that just moves a bit quicker and will give you earlier signals. So kind of 4-hour and hourly closes instead of waiting for the daily close. But other than that, I think it's a very similar story here. I'm not a huge fan of the market sort of testing the same level 3-4 times without really going anywhere. ETH BTC, I'm still finding it very hard to care about. So obviously, we had a failed, not even a failed breakdown attempt necessarily, but a spike through the 048 lows and a bit of a reaction. In general, I find I refuse to get baited into caring about ETH BTC too much for the time being. Even on days where it looked like it was going to absolutely rip up and trend reverse and keep going, those have sort of petered out. And so my bar for caring about ETH BTC is almost unreasonably high at this point, especially if the market is going to be weak and or remain weak. I think the reasons for caring about ETH go down as well. I think ETH BTC is very interesting when it's strong in a strong market, so you can kind of have an understanding of where to bias your trading when it comes to the majors, or how to denominate your portfolio, which ecosystems to look into. Is there a sort of layer 2 type ETH coin wealth effect? All of that kind of stuff kind of is sort of the prerequisite for that is bullish price action. I'm not too interested in ETH BTC windows of strength if the market looks like a piece of shit. ETHUSD itself, I mean, it still bounced at 3K, which is nice. I'm having a bit of trouble picking the exact level that I want to use for this. I think in the past Monday markets, we used 3K, which is very reasonable. But this is one of those where TA gets a bit cloudy, right? So if you have 3K as your support, then support held, and then, it's sort of still above it, which is fine on the weekly. If you were to use the high, it looks like total crap with a failed breakout, and that's just not good news. And then if you were to use this weekly cluster to the left, it's a bit of a mixed bag with a close above the bottom boundary, but still sort of trading in that area and not much of a bounce to write home about. So I'm not too fond of ETHUSD for that reason. I think there's just a lot of ambiguity around 3K. And also, just in general, if this thing breaks down, I think at least we'll remove the ambiguity as insofar as where the next level is, which for me would be this entire consolidation, 2.2, 2.4K. You could just literally draw a level at 3K flat as a round number support meme and see where that takes you. But I think ETH, again, similar to the discussion we had with these mechanical pump and dumps, you got your wick entries 2.8 at an extreme, and then it ended up then bouncing into the nearest level of resistance at 3.1. So again, there was a totally reasonable trade if you managed to get close to the low of the day, 2860, 2880 to even 2900 into that level. There's a decent unlevered 9% there, which is definitely tradable. But at this point, if you're chasing the market now, it's much harder contextually to make that same case, because we're closer to resistance than we are support, at least in the local sense. So if you're thinking of this in terms of structuring trades, the whole buy the liquidations mechanical bounce trade is done, and the next trade is just less clear as a result. And in general, if you miss out on the liquidation, mean reversion, bounce type of trade, rushing into the market soon after that portion is done tends to not be so great, because again, the price, that sort of post liquidation flow is always a bit sort of heavy and slow and shitty in comparison to more regular price action. If you wanted some level for ETH, at least for intra-week bias on the support side, I would be more comfortable just going for 2,900 to 3K. That seems like a pretty good daily technical level and inflection point as far as determining bias, and it has enough crossover with the weekly levels for me to feel comfortable that there's some sort of structure there. And on the resistance side, look, if you're short-term trading, then you obviously respect the nearest structure at 3.1K, but that's even funny to talk about because A, we're there now, B, the space between 3K and 3.1K is like comical and like almost not worth trading unless your entries are really good towards the tails, and even then you should be, that only makes sense with perps and so on and so forth. So yeah, that's ETH. Didn't really present a view. I think this is one of those market pockets where things kind of look crappy. There was a nice bounce from support, but chasing that bounce from support now from a trading perspective in the short to medium term is tricky because it's sort of the easy portion's already played out and it's closer to resistance than support, as I've said before. The altcoins that are on my watch list are Solana, WIF, RNDR, and Ondo, just based on historical mindshare as well as recent price action. For Solana, not as much ambiguity in terms of what's the important weekly level. For me, that's 135. Any weekly close below 135 would just look pretty bad because this is a pretty massive inflection point. I would then look towards sort of 100 round number and potentially lower. So if you're short-term trading this, again, this is like a really good example of what I was talking about. If you're getting the licks and the wicks, you had a really good couple of days, but then if you chase the market, on the daily close, for example, saying, oh, look, support held, and then it closed above, I'm going to buy, you've been underwater all day, and it's just not a fun type of environment. And oftentimes, when the market will have these liquidation-driven moves with large wicks, you'll get a mechanical bounce, and then on the mechanical retrace, it's not uncommon for the market to start to backfill some portion of the wick as well, or at least sort of trade closer towards the point of control and so on and so forth. And that's why that post-liquidation flow is shitty. You're either catching the liquidations or you should just wait, to be honest. As boring as that sounds, I think that's a reasonable framework. WIF is a very, this thing did quite well on the bounce, but perhaps more importantly, it just trades very technically as a whole. So if you'll recall what this daily cluster looks like that we've discussed previously on the show, between $3 and $3.20, that was the range low / support level, and you had a very technical breakdown and retest of that type of level. So again, if you were catching wicks and de-risking at resistance, sort of very mechanical, get some liquidation entries and sell the nearest level, that was a really good trade. But at the moment, that trade is kind of mostly played out and the structure just isn't the same anymore. And it just looks like a bearish retest, if anything, at the moment. I think the next potential area to redo business would be the 2.1 range low. That's kind of the only structure that you have here. And that would make market structure not look completely appalling. Anything below $2 round number would start to look pretty shitty. But again, we're making this video between levels. So again, the timing on many of these is unfortunate, where if 2 is your support and like 3 is your resistance, we're literally trading at 2.5. So like, what do you want me to say? Diddle in the middle? Come on, you know better. Yeah, so that's WIF. And again, this is a really good example of the opposite of what we had with Ethereum, where even if you have the support, because the resistance is so close, it's almost not worth trading because there isn't that much space between the nearest support and the nearest resistance. If you take the nearest support, nearest resistance for ETH, from $2 to 3, there's like 50% there, unleveraged. So those types of trades, if you're looking to structure that type of trade, ideally you want to look for something that has a lot of space between levels to actually make it worth capturing. If all this shit is really squished together and you're very technically minded and less sort of flow minded, it becomes much harder to almost sort of justify taking a risk on those. But if there's a lot of space between the nearest support and the nearest resistance, and you're taking those types of short-term bounce trades, I would look for pairs that have that feature. RNDR is another one. It's kind of caught my eye because of this listing level that I had on the weekly, just under $7. And then if you look on the daily, there's a pretty decent range low structure there at, well, $7 to $7.50. I think this is one of those, again, right? This shows the anatomy really well, where you get the market overextending and almost even sort of overcutting the high time frame support level, and then you get a really good bounce, and then that bounce sort of fizzles out at the nearest resistance level, which was the breakdown level on RNDR itself. So like at the time of recording this video, that trade is done, right? The crash into high time frame support has played out, the move into the first trouble area has played out, and there isn't a ton to do unless you're like super high conviction on that being the bottom, in which case I guess anything is a good entry if your target is new highs. I'm not quite there yet. Again, that's for two reasons. One is I'm just a conservative boomer who's not a fan of V reversals and fucking misses them all the time. So maybe that doesn't apply to you. But the second is because of the magnitude, as mentioned, of this open interest wipeout, I'm personally not expecting a V reversal. Now, if I'm wrong, then these things will have just hit support. Maybe they're down for a day or two and then they make new highs and I think, oh fuck, I should have bought all the liquidations. And that's completely possible. You know, there's no religion on this channel as much as we reference the Bible. But that's just not really A, my base case, B, my trading style. So I'm just kind of outlining that so you're aware of my preferences and my biases. I put Ondo here because I just had a very strong reaction when the market bounced as a whole. I think there's a pretty decent technical level at 74 cents to 70 cents as a whole. And this is one of those where I would count this down day as a failed breakdown attempt. So if the market comes back to 70 to 74 cents and it's bullish, then that support is probably your last / only area to do business. Once the market kind of fakes out a level once, if it starts closing below it again, the probability that it's a second fake out so soon after the first one is quite low. I think the probability that it's a real breakdown is quite high. So at least that technical level makes sense, and that's why I put it on my watch list. As far as futures and just kind of the market as a whole, looking at the damage done, if you look at the quarterlies basis, it's sort of crept back up to double digits from a low of sort of 7%, depending on venue. Obviously, there's a bit of dispersion between these, but we're back up to double digit basis. Now, again, this is one of those things where absolute numbers only sort of make sense at extremes when things either get backwardated, which is to say that the future is trading below the index price. Those tend to make for pretty good entries because on average, the market trades at a premium when it comes to futures. And then when you get like really crazy basis numbers, like triple digits on BTC type of stuff, like also when it comes to like mega froth on altcoin funding. So in those cases, the absolute numbers can be interesting. But on average, if you just look at the number, then you miss out on a lot of context. So for example, you can have 15-20% basis on quarterlies on BTC if the market is melting up, and that will be completely fine. You would be ill-advised to make an argument based on, oh my god, look at the amount of leverage, if the market is just completely ripping faces to the upside. At the same time, double-digit basis, if the market shows weakness and continues to break down, can become problematic. So ordinarily you'd think, well, we were fine at 20% quarterlies basis, now we're at 10%, isn't that good? My answer is it depends on the price action. Good price action can bail out large premiums, but bad price action can make even relatively modest premiums look worse than they are and still signal weakness across the board. So it's not that I would disagree with analysts who look at these numbers in sort of absolute terms on their own. They always need to be measured in accordance with price action and see if the two are sort of concomitant. And if they are, then you can sort of swallow large premiums if the price action allows for it. And it works the other way around as well, where even a quarterly basis and premiums that look generally unimpressive, if the price action is a piece of shit, then that leverage is still gonna, or is still at risk of being flushed. Okay, that's my view at the very least. The same when it comes to a lot of funding analysis. Obviously, depending on venue, I mean, Bybit's very negative at the moment, but other venues, from an APR point of view, sort of single digit, depending on OKX. I think Binance was at double digits if I checked. So again, a bit of dispersion going on there. One thing to note when it comes to looking at funding rates after these types of moves, as a reminder, funding rates are a function of where the perp is trading relative to the index, right? So if this is the index price and the perp is trading above it, funding will be positive. And if it's trading way above it, funding will be more positive. And if it's below the index price, that's a T, not an I. Now it's an I. If the perp is trading below the index price, the funding will be negative. And obviously the more dislocated it is from the perp price, the more negative it will be to incentivize people to push this thing back in line with the index. That's what funding does. It looks at I and it looks at P, and it tries to incentivize the two to be as close as possible to each other. So if it goes way above, there are incentives to bonk it down by selling and getting paid the funding rate. And if it goes too far below, then you are incentivized to bonk it back up by getting paid the funding rate. A lot of the times when you get these types of really fast moves that wipe out leverage, you'll see commentary made about, oh, look how negative funding is, funding's negative, so on and so forth. And that's inferred to mean that, or I guess if the person's writing the tweet is implying that there's a lot of shorting going on and the reader infers that the bears are being very aggressive, right? Now, in many cases, that's just simply not true. There's a key distinction between these two instruments, which is that the index is made up of a basket of spot instruments, whereas the perp has leverage. And so when you get large, fast, aggressive moves in the market, because of that same leverage, the perp will get significantly dislocated relative to spot. Those liquidations will just drive price lower than it would ordinarily go, or drive price higher than it would ordinarily go, because liquidations are a very messy, inefficient, sloppy type of process. So a lot of the time when you see, oh, negative funding, everyone's shorting type of arguments made, even if funding is negative, a lot of the time, at least a large part of the reason why the perp is trading below the index is because of those liquidations pushing that specific product below the index price. So it's not necessarily indicative of fresh positioning coming in and shorting the bottom, but a lot of the time it just means, hey, there were a ton of liquidations and this perp got absolutely hammered relative to the index because of all the liquidations and the leverage that came out of the system as a result. So that's just a bit of context to bear in mind. Negative funding type of arguments become better as more time passes post-liquidation. So for example, if the market just kind of started to round out and consolidate and the perp stayed trading in a significant discount to the index and you had open interest going up at the same time, then you could start to make an argument that, hey, there actually now is a lot of fresh selling coming into the market and it's not going anywhere, so maybe we'll get a pop up. I think that type of argument is more compelling. But just looking at negative funding in a vacuum without considering how the perp got there in the first place, if it's trading below the index price, I think will give you an incomplete analysis. So bear in mind not only what the funding rate is, but perhaps more importantly, A, how it got there /Y, and B, what happens afterwards. I think those are more important than just looking at red or green funding. I think that's all I've got to say. Hopefully this video was helpful, at least some educational tidbits of it. Leave a like. If you enjoy these, subscribe to the channel because that's a nice number to look at. Thank you to Woo for supporting the show as always, and thank you to all of you for the well wishes. I am fully healed and we're back on a normal schedule. Hope you all had a fantastic weekend, and I'll see you next week.